every call that I make, it's all about probabilities, right? So inevitably I'll be wrong on one or two, but it's the goal of making the correct calls on most of them because you're following the charts and the charts are giving you the probable likely outcome. Yeah, so I'm thinking 2023 is going to be even more volatile than 2022 in terms of downside. You can see here, I mean, here's the S&P or the spider chart, and we have this beautiful trend line, right? I mean, trend lines are just amazing things. You have the high, all-time high back here. This is in December or January of 2022 right there, and it literally kisses every point here. And what I think was the most important to me recently is we had that CPI number, and the markets gapped above that line. And that was the perfect opportunity for the markets to rip higher. They were above resistance and they couldn't do it, right? So we talk about how failed moves become big moves in the opposite direction. And that's what we've seen here. I mean, since then, it's just been down hard on the S&P 500. So I look at it like, inevitably the Fed will back off on rates. That may give the market a few bounces. But the problem now is that pretty much everyone's very aware that we're going to head into a recession. And the question then becomes, how do we get out of the recession? On a macro basis, if the Fed can't print us out like every, pseudo recession in the last 20 years or 10 years, how does the market get out of it? How does the economy get out of it? And I think that's going to be the big concern for 2023 is, inflation remains, let's say, at 4%. The Fed can't go back to their playbook of low rates and printing money. So for me, down 25% in 2023 is kind of my ballpark number, give or take. But I think it's going to be a wild and nasty year. Yeah, 100%. And you're right. Historically, we can see that in past pivots have actually been very, very negative. Now, it doesn't mean you don't get the relief rally, right? There's that quick short-term relief rally, but it's usually one of those opportunities to sell into the strength for the next leg lower. And it makes perfect sense too, because, it's a pivot, but you have to keep in mind that inflation number, right? So you were at 9% here in the US. We're probably going to come down to 4 or 5%. But that last 2%, from 4 to 2% on inflation, which is where the Fed wants us back to, I think that's going to be really hard to get to on a macro basis. So it's going to be a situation where the Fed is kind of handcuffed from really stimulating growth as we get into these recessions. And once the market realizes that, that's where it really gets scary for the economy. I think you can't say, and you have to think along the lines of the dot-com bubble in terms of how crazy things got. The NASDAQ took 15 years to get back to those highs. And we could even be looking at a longer period. One of the charts I love to show people is the EWZ, which is it's the Brazilian ETF. And what you can see here is that the Brazilian ETF had this amazing vertical run, which looks very similar to the markets from 2009 in the US to 2022, right? This really vertical move. And if you look at this, the Brazilian market hasn't even broken out of this wedge pattern in the last, now we're talking 2008 to 2022, so about 14 years ago. And so you have to think again that it's very possible that we're going to be in this long-term kind of, it's hard to call it a bear market because I think there'll be bull markets within the bear market, but I don't think we'll make new all-time highs for a long time. One of my favorite markets to keep an eye on now is the Brazilian market. In fact, that and the Hong Kong market, because to me, it's looking at this chart and recognizing that eventually all markets do break out of their cycles here. And so if you also realize that because the US was doing so much stimulus, it drew a lot of foreign money into the US market. So if the US markets go into this kind of sideways downward move for a long time, money is going to start leaving the US and looking for other areas. And I think, this chart, the Hang Seng market, I think the Hang Seng chart is really interesting as well. Obviously, China does come with a lot of risks, but look at this weekly chart on the Hang Seng. In fact, we'll go to the monthly chart. Same kind of thing. You had this big move up into 2008, and at least you double topped over here, but you could see you still have never broken out in the last 14 years. And so I do think that other markets like this could be of where the money is headed. See this long period bear market in the US. I think gold is going to be a big recipient, especially if inflation remains sticky just above that 2, 3, 4% range. I do think eventually Bitcoin becomes that. The biggest thing with crypto right now is you need that regulation. So you got to get regulation that'll create transparency, which then in turn will make it investable for big money. Right now, especially after FTX, too many big money players were injured. They were hurt. They're not going to go near crypto. No one else is going near crypto with big money. Once you get that transparency, you could then argue maybe you can draw some money in as an alternative investment to stocks, more of the digital gold with Bitcoin. But one of the things I wanted to show you guys is just a fascinating chart. This is the S&P 500 chart going back to the mid 90s. And what we could see is this was your .com move up. Then you had your bear market, your financial lead up, your real estate boom, your financial crisis. And then this is the run we saw in the S&P. Now, what's kind of spooky about this is that if we go to the Dow Jones Industrial Average chart, look at this. I'm going to go to this. We're going to flip to the monthly chart. And I want to go back to the 1910-15 range and look at this. So it's very scary how, and this is what I love to do with history, right? I mean, history is the coolest thing ever. But if you look at this pattern, it's the same pattern leading into the roaring 20s, leading into the Great Depression. And again, I'm always hesitant to make some call like that we're going to have that type of event, but you can't deny the similarities in charts, nor can you deny what was going on here. So like if we look at the 1915 to 1920s, what was going on? Well, cars were emerging, so people could start traveling, which means more commerce could go along. You could start shipping things everywhere because you could put them on trucks. You had electricity going into homes, which meant you could have homes and businesses open after dark where that people could be going out to shops and shopping. So it created this consumer kind of buying frenzy, right? Which led into the roaring 20s. And so you had consumer spending. We had loose credit in the 20s as well, which then led us up to obviously the Great Depression, the crash in 29. And then if you look at the S&P 500, what emerged in the late 90s? The internet. All right. And the internet revolutionized shopping as well and consumer spending. Now you can go on Amazon, you can buy everything you want online, you have it shipped right to your home. So it really created this new environment of consumer spending. We know that the lending standards had deteriorated as well. And it's spooky to see those kind of similarities where you had these events that kind of led to these boom periods. But then obviously in the 20s leading into the Great Depression, what happened after? So just little fascinating things like that I think are worth kind of paying attention to. I mean, in reality, right? I mean, it probably means there's further downside on Bitcoin, but I do think that Bitcoin is, it's getting closer and closer to those lows. And just by mathematics, it is, right? I mean, it was at 69,000 and now you're at 16.6. So there's only a certain amount it can go down, even if it were to go to zero. But I think for me, there still is this intrigue and need for something like Bitcoin. So ultimately, I think it goes to 10,000, 9,000 area. I've likened the FTX fiasco to the Lehman Brothers collapse in terms of the psychological impact on the markets, the S&P 500 back in 08, leading into the 09 bottom. And then same thing here with crypto and the kind of the psychological impact leading into it. And you guys are chart guys and you understand the human emotion of it. So it's kind of like this, when you have this kind of blow up, it creates that despair, that beginning, that kind of that last cycle of fear that markets usually bottom on. So I still think we're going lower. I still think that, again, you still have risk assets that'll be sold off. You don't have transparency, all these things in the crypto market. But I do think that the end is getting closer for a potential bottom. I just don't think I think everyone thinks Bitcoin's going to magically go right back to the all-time highs as soon as it makes a bottom. And realistically, it won't do that. It'll probably take quite a while. I think in the nines, mainly because I think there'll be a lot of triggers of stops right at 10 when it breaks 10. Psychologically, that's going to be max pain for a lot of people. And we know that the markets tend to push people to that level. So I think it makes sense that it pierces 10. Where it goes below, maybe 9, 9.5, that's kind of the zone. Be interesting to see the next when you have the halving or whatever they call it, where Bitcoin again becomes harder to mine. I think that's in early 2024. Does that have an impact?
Right.
Historically, we've seen that it does have an upside impact, but that's been during money printing, right? If the Fed still isn't printing and we're not seeing printing here, does it create this longer bear market where we kind of just sit around lows or chop around for a long period of time? And again, I'm not sure because we don't have a lot of historical information when the Fed wasn't printing with Bitcoin. People mention things. And what I use is I actually use Twitter as a great place to kind of gauge sentiment. And so if I post an idea, like a good example was when Bitcoin was topping and I was saying, oh, it's going to go to 20,000 or below, the amount of kind of pushback I got was incredible. And that actually reinforced my feelings that it would actually happen. Same thing with oil at $130. I would post up, no, guys, I think the chart's telling me it's going down. and people, oh, you're crazy, it's going to $200, you don't know what you're talking about. I'm like, all right, now I'm probably going to be right, you know, like, so, and it's just,
Yes,
and again, this is all human psychology. It has nothing to do with the fact that it's just, that's just the makeup of the general public, is that they're going to go with what the common thought process is. And in general, when everyone feels that way, it's not going to be that way.